I get asked on a regular basis, so how's the commercial real estate market? I hear it's in the tank. My standard response is, which asset class are you referring to? Office, industrial, retail, multifamily, hospitality, leasing, or sales? One size does not fit all in this case. Interest rates, refinancing pressures, and shifts in tenant demand are shaping the market in ways we haven't seen in over a decade. Hi, I'm Gayle Berkbigler, CCIM, based in Austin, Texas. Around here, they know me as doing commercial real estate deals in heels. I've been around this industry long enough to see cycles rise and fall, and I know how confusing it can feel when headlines sound gloomy, but great deals are still getting done every day. That's why in this video, I'm going to break down the state of commercial real estate in 2025, what's happening, what it means for you, and how to position yourself for success, no matter which side of the deal you're on. We'll take this step by step in plain language, and by the end, you'll walk away with a clear picture of what's really going on in commercial real estate this year. So let's start at the top with the single biggest driver behind almost every decision right now: interest rates. Number 10, interest rates, higher for longer, but not forever. To really understand what's happening in commercial real estate this year, we have to begin with the cost of money. Interest rates set the tone for everything else. If there's one thing you're probably noticed, is that the cost of borrowing money is still high compared to what we got used to in the 2010s. Sure, rates have pulled back down a bit from the absolute peak, but haven't fallen back to those record lows. And the truth is, most experts think that we're in a higher for longer environment. What does that mean for you? If you're buying or refinancing, your debt service coverage ratio is more important than ever. Lenders are stricter, and you may need to bring more equity into deals. It also means that cap rates are adjusting, not collapsing, but widening compared to the days when cheap debt made every deal look good. So the strategy: underwrite conservatively. Don't fall in love with yesterday's pricing. If the deal works at today's debt cost, it's a solid one. Number 9, price discovery. Buyers and sellers are finally meeting. Once you understand the rate environment, the next logical question is, how are deals actually getting priced in 2025? For the past couple of years, one of the biggest challenges was that we call the bid-ask gap. Sellers still wanted yesterday's prices, and buyers wanted a discount. In 2025, we're finally seeing that gap narrow, but here's the catch. Price discovery isn't happening evenly. It's not like values across the board are dropping 20%. Instead, it's selective. Strong assets in good markets are still commanding strong pricing, while weaker properties sit longer, sometimes waiting for that right buyer. If you're selling, that means you need to be transparent, bring updated financials, insurance, quotes, and show a realistic story. If you're buying, it means you still face competition on well-located properties, but you'll also find opportunities where others hesitate. Number 8, office, a market split into two. Now let's talk about the sector that makes all the headlines: office. This is the area that's gone through the most dramatic shifts since the pandemic. In 2025, the story hasn't gone away, but it has gotten more nuanced. High-quality, modern offices with great air, light, amenities, and flexibility are still attracting tenants. These buildings are often full or at least leasing at steady rates. On the flip side, commodity office space, the older, uninspiring stuff without upgrades, is struggling. Conversions to residential or mixed use are slow, expensive, and very complicated. So the reality is we're living through a tale of two markets. If you're an owner, you need to lean into the upgrades that actually attract tenants, like spec suites, hospitality style amenities. If you're a tenant, this is your chance to negotiate. You've got more leverage than you ever did in 5 years ago. Austin's office vacancy rates remain historically high at 16.3% as the market grapples with a surplus of new high-quality office space following a historic development cycle over the past few years. Over the past few years, leasing declines. It is down 37% from the 5-year pre-pandemic average. Asking rents held steady last year, growing by a modest 0.6%, while landlords are holding firm on face rents. Effective rents are under pressure due to elevated concessions. Austin continues to benefit from a business-friendly climate, strong entrepreneurial spirit, and a highly skilled, educated workforce that could drive demand higher over the long term. As a result, the market is positioned for a gradual recovery beginning in late 2026, particularly if speculative office development remains constrained. Number 7, industrial. Coming back to earth, moving from office to industrial, the tone changes quite a bit. Industrial real estate had a wild ride during the pandemic. Demand for warehouses exploded, rent shot up, and vacancy was almost non-existent. But by 2025, the market has normalized. Vacancy has ticked up, but it's still healthy. Rent growth has slowed from double digits to more sustainable levels, and we're seeing more sublease space hit the market. The key point, industrial is still solid, just no longer overheated. For tenants, this is a good time to secure space with better concessions. For owners, it's a reminder to focus on property management, maintenance, and tenant retention rather than assuming endless growth. Number 6, retail, the quiet outperformer. After industrial, let's shift to retail. And here's where we find a surprise. Retail is doing better than many expected. Why? Because we simply haven't been building much new retail space. Limited supply combined with demand for grocery, fitness, medical, and service tenants has kept neighborhood centers strong. This doesn't mean every retail strip is thriving. Malls are still struggling, and weaker locations face vacancies. But if you own or lease a grocery-anchored center, chances are you're in good shape. Austin's vacancy rate of 3.2% remains at a historic low. Strong demand and limited space have led to tight market condition in Austin's retail market. The market's fast-growing population, rising household incomes, and robust consumption continue to draw retailers' attention, driving sustained high demand for retail space. Austin ranks among the country's fastest-growing city, which much of this growth is occurring in the metro, outer regions, a vital source of retail demand. If you're a retailer, make sure your lease includes exclusives and co-tenancy protections. If you're a landlord, keep your center well lit, safe, and inviting. These simple details still drive foot traffic. Number 5, multifamily. Absorbing supply, then tightening. Now shifting over to the multifamily, the story is all about supply and timing. But here's the thing, new construction has slowed dramatically. So while 2025 is about working through new supply, 2026 and beyond look much tighter, with demand outpacing supply in 2025 for the first time since 2021. Strong demand combined with slowdown in new supply reduced the vacancy rate by 150 basis points from fourth quarter 24 to fourth quarter 25, reaching 14.3%. The reduction ranks among the sharpest in the country. If you're a tenant, take advantage of deals now. If you're an investor, underwrite with today's rents, not yesterday's hype. And if you're an owner, focus on renewals, long-term retention, because once the pipeline slows, your property will be in high demand again. Number 4, data centers. Power is the new location, from homes to high tech. Let's talk about one of the fastest growing asset classes, data centers. Demand is exploding thanks to AI, cloud, and streaming. But here's the twist. It's not about land anymore. It's about power. Markets are constrained not by acreage, but by access to electricity. That's why we're seeing a huge focus on locations with transmission capacity and utility partnerships. If you're playing in this sector, timelines are longer, but the demand story is undeniable. Number 3, insurance and construction, the hidden costs. Of course, it's not just about the asset type. One of the biggest under the radar stories of 2025 is rising costs outside of rent and debt. Insurance premiums, especially for older assets or coastal properties, are skyrocketing. Construction costs are still elevated, not crashing the way some had hoped. If you're an owner, don't underestimate these costs. If you're a tenant, always request quotes before you sign a lease. These hidden costs can make or break a deal's economics. Debt maturities, the refinancing crunch. Now let's address the pressure point that has everyone in the industry watching closely. Debt maturities. Billions in loans made at ultra-low interest rates are maturing in 2025 and 26. Refinancing them at today's higher rates means smaller loan proceeds, leaving gaps that need to be filled with equity, mezzanine financing, or creative structures. If you've got a loan coming due, don't wait. Start early, refresh valuations, and talk to multiple lenders. I have referrals for you based on your asset class. If you're an investor with capital, this is where opportunities will open up. Owners under pressure may be willing to sell or recapitalize. Number 1, playing smart. What this all means for you. And that brings us back to the big picture. What does all of this really mean for you, whether you're an investor, owner, a tenant, or a developer? The state of the commercial real estate in 2025 is not doom and gloom. It's selective, it's nuanced, and it's about being prepared. If you're an owner, focus on cash flow, tenant retention, and expense control. If you're an investor, buy quality, strong locations, multiple exit options, and realistic rents. If you're a tenant, this is the time to negotiate flexibility and improvements into your lease. If you're a developer, phase your projects carefully and make sure you've lined up financing and utility capacity. The winners this year are those who model conservatively, stay flexible, and move quickly when opportunities arise. I'm Gayle Berkbigler, CCIM, and this has been Doing Commercial Real Estate Deals in Heels. My mission is simple: to make commercial real estate knowledge accessible, because this industry has been a good old boys club for too long. If you're leasing, buying, selling, or just trying to figure out how to navigate the market this year, I'd love to help. Together, we won't just talk about the market. We'll get you the kind of deal that truly works for you and your business, your budget, and your future.